Hello, everyone. I want to start with a question. Imagine you're buying a house. The seller gives you this offer: pay me a small fee today, and I'll lock in the price at $400,000. But you have 90 days to decide whether you actually want to buy it. If prices shoot up, you get the house at the old price. If prices fall, you walk away and you only lose that small fee. That, in essence, is the logic behind an option. It's a contract that gives you the right, but never the obligation to do something. And today we're going to unpack how these instruments work, how they're priced, and why understanding them can make you a sharper, more strategic investor. Let's dive in. So formally, an option is a contract giving you the right, but never the obligation to buy or sell a stock at a predetermined price. There are two basic flavors. A call option is the right to buy. You purchase a call when you believe the stock price is going to rise. If it does, you get to buy at the lower locked-in price and pocket the difference. A put option is the right to sell. You purchase a put when you expect the stock to fall. It functions almost like insurance. You can sell your shares at the higher agreed upon price even if the market has dropped. One important housekeeping note: a single option contract doesn't represent one share. It represents 100 shares of the underlying stock. That multiplier matters a lot when we talk about pricing, so keep it in the back of your mind. Now, before we can trade options, we need to be able to read them. Every option quote packages four pieces of information. First, the underlying stock, the company whose shares the option is tied to. Second, the type, call or put. Third, the expiration date, the deadline by which you must act, or the right expires worthless. And fourth, the strike price, the locked-in price per share at which you can buy or sell. Here's a concrete example. The quote, XYZ July 50 call tells us this is a call option on stock XYZ expiring in July with a strike price of $50 per share. It's almost like a shorthand code, and once you can decode it, any option quote becomes immediately readable. So how much does an option cost? The price you pay is called the premium. If an option is quoted at $5, the actual cost is $500, because remember, each contract covers 100 shares. The premium is made up of two components. The first is intrinsic value. This is the real tangible value of the option if you exercise it right now today. For a call option, intrinsic value is simply how far the current stock price sits above the strike price. If the stock is at $55 and the strike is $50, there's $5 of intrinsic value. The second component is time value, and this is the more interesting one. Time value is the extra amount the market charges for possibility. It's the premium you pay for the chance that things could get even better before expiration. Some people call it the value of hope. The formula is simple: time value equals option price plus strike price minus stock price. Understanding this distinction between what an option is definitely worth versus what it might become worth is foundational to everything else we're going to cover. Let me show you how these two components shift depending on where the stock price is trading, using our XYZ July 50 call as the example. When the stock is at $45 below the strike, the option is out of the money. There's no intrinsic value because you wouldn't exercise the right to buy at $50 when you can buy on the open market for $45. The premium is just $1, made up entirely of time value, the market's bet that things could still turn around. When the stock is right at $50, exactly at the strike, we call it at the money. Still no intrinsic value, but notice the premium jumps to $5. That's all-time value, and it's at its highest. Why? Because there's maximum uncertainty here. The option sits right on the fence. It could finish in the money or out of the money. That uncertainty is expensive. When the stock climbs to $55 above the strike, the option is in the money. Now there's $5 of intrinsic value, but the total premium is $8, meaning time value has actually dropped to $3. As the option goes deeper in the money, there's less drama about whether it will finish profitably, and so the time value premium shrinks. This brings us to what I think of as the four pillars of option pricing, the key forces driving how much a premium costs. Pillar 1, stock price. As the stock rises, call premiums rise with it. At expiration, this becomes the most dominant factor of all. Pillar 2, strike price. The closer the strike is to the current stock price, the more at the money the option is, the higher the time value, as we just saw. Pillar 3, time to expiration. More time means more chances for a favorable move. An option with 6 months left is worth more. All else equal, then the same option with 2 weeks left. Time is opportunity, pillar 4, volatility. This one surprises many new learners. A stock that swings wildly day to day commands higher option premiums than a boring, stable stock. Why? Because sellers of options are taking on more risk with volatile stocks, and they charge accordingly. If you're selling someone the right to buy a roller coaster stock, you want to be well compensated. These 4 pillars explain the vast majority of what you'll see in real option pricing. There are 2 additional secondary factors worth knowing. Dividends tend to lower call premiums. Here's the intuition. On the ex-dividend date, the stock price drops by the dividend amount. Since call holders don't receive the dividend, the right to buy that stock becomes slightly less valuable just before that drop. Interest rates have the opposite effect. Higher rates tend to raise call premiums slightly. This reflects the opportunity cost of capital. It's a smaller driver in everyday pricing, but it's baked into professional models like Black-Scholes, which you'll encounter if you go deeper into this subject. Now I want to talk about one of the most important concepts for any option buyer to internalize. Options are wasting assets. Unlike a share of stock, which you can hold indefinitely and which could theoretically recover from any setback, an option has a ticking clock. Every day that passes, its time value shrinks, even if the stock price doesn't move a single cent. For buyers, this is the ever-present headwind. Time is the one pricing factor that works against you relentlessly. For sellers, it's the reverse. Time decay is your ally. This asymmetry is a critical reality of options trading. It's not enough to be right about the direction of the stock. You also have to be right fast enough. Here's where it gets mathematically interesting. Time decay is not linear. It doesn't chip away at the premium in equal daily installments. Instead, decay accelerates as expiration approaches, following what's called the square root rule. The decay rate is inversely proportional to the square root of the time remaining. In plain English, a 2-month option decays at twice the rate of a 4-month option, not the same rate. The practical consequence is dramatic. An option can lose half its time value early in its life somewhat gradually, but in the final weeks and days before expiration, time value can evaporate at a breathtaking pace. For buyers, this is a warning. The longer you hold a losing position, the harder the clock works against you. For sellers, this is a strategy. Selling options with near-term expirations captures the steepest part of that decay curve. At expiration, the math becomes clean and unambiguous. Time value has completely vanished. The option trades at what we call parity. Its value equals its intrinsic value and nothing more. For our XYZ July 50 call, if the stock closes at $45, the option is worthless. If it closes at $55, the option is worth exactly $5. If it closes at 65, it's worth exactly $10. The market has rendered its verdict, and time is no longer a factor. One more practical note worth knowing: the Options Clearing Corporation acts as a safety net for investors. If your option finishes even a penny in the money at expiration, the OCC automatically exercises it on your behalf. You don't have to remember to act, the system has you covered. So let's bring it all together. Options are contracts that grant rights, not obligations. Every premium is a blend of intrinsic value, what the option is worth right now, and time value, what the market believes it could become. 4 pillars drive pricing: stock price, strike price, time to expiration, and volatility. And options are wasting assets. Their time value decays non-linearly, accelerating sharply as expiration nears. If you want to go further from here, the natural next steps are exploring strategies like covered calls and protective puts. Getting familiar with the Greeks delta, gamma, theta, vega, which measure how sensitive an options price is to each pricing factor, and studying the Black-Scholes model in more depth, and before putting real money to work, paper trade. Practice in a risk-free environment until the mechanics are second nature. Options can be powerful tools for managing risk, generating income, and expressing market views with precision. The key is understanding what you're buying and what the clock is doing to it every single day. Thank you.